Hey, what's up? I'm sharing which international dividend ETF that I just bought and why you might want to check it out too. But we're also going to look at why US stocks might be overpriced, why international stocks could be a smarterson move right now, and which international dividend ETF might be best for dividend growth investors like myself. And be sure to share your favorite international dividend ETF or stock in the comments below. For those of you that might be new here, what's up? I'm Russ, a Chicago welder who installs and repairs loading dock equipment at warehouses and factories all day long. And I'm learning about investing through podcasts and audiobooks all day, whether I'm driving or working. And I started investing late, and in my 20s and 30s, I saved 1% to 5% of our income. But now we're currently saving 36% of our income. And as of this recording, we are officially 85% of the way to being net worth millionaires. So I'm not a financial professional. I don't have any fancy letters after my name. I am just a regular guy with a passion for passive income, and I'm sharing that with you. So why look at international stocks now? According to this Morningstar article from January 2025, US stocks are trading at about 22 times forecasted earnings, while the rest of the world is only at about 13 times. That is a huge valuation gap. That same Morningstar article points out that US stocks are trading at about 2.7 times sales, meaning you're paying $2.70 for every $1 of sales and 4 times book value, while international markets trade at a much lower valuation, about 1.2 times sales and 1.6 times book value. So this isn't just me saying this. Reuters reported that the valuation gap between US and international stocks is near its widest in over 20 years. And many experts think that this gap is just too extreme to continue. And I came across this Charles Schwab 2025 Global Outlook, which pointed out that while the US market has outperformed recently, this pattern might not continue. Their research shows that international stocks often catch up, and rising valuations, supported by central bank rate cuts, are likely to boost returns for international stocks this year. And even in 2025, US News reported that, quote, international stocks are substantially undervalued when you look at metrics like price to earnings and price to book ratios compared to US stocks. So with valuations like this, looking at quality international companies that could benefit if the gap starts to close, I think just makes a lot of sense. So with these international valuations looking so attractive, and I have a hard enough time understanding a lot of stocks in my own backyard, I think it just makes sense to hit the easy button and look at ETFs that are focused on international, non-US dividend-paying companies, because you don't have to research the individual companies, so you're buying a basket of stocks with an ETF. So I thought I would look at 5 popular international dividend ETFs. So the 5 were VIGI, the Vanguard International Dividend Appreciation ETF, VYMI, Vanguard International High Dividend Yield ETF, SCHY, the Schwab International Dividend Equity ETF, IDV, the iShares International Select Dividend ETF, and DWX, the Spider S&P International Dividend ETF. If you want to check this out, there's a link for it below, and it's a Cinco de Mayo snapshot, meaning I filled this out and tabulated it right around Cinco de Mayo 2025. A lot of it is self-explanatory, and slide over to the right and you'll see there's a few more columns with things like the dividend rate, the frequency, just kind of the nuts and bolts, because remember, when you buy an ETF, you buy the methodology, what's under the hood of the ETF. You're not buying per se the individual names that are in it right now today, which is why I have this area for the selection methodology. But also, if you hover over the ticker symbol name, you can go to the Seeking Alpha Summary page, which I have a perpetual affiliate link with them. So if you want to save a bunch of money on an annual subscription, click that link below. And then if you hover over the name, this is the summary page from the fund manager, website. So click on that and you can go there, which you'll see on VIGI. Ooh, look at that. They just lowered the expense ratio for 168 shares across 87 funds, did Vanguard. So this is VIGI. This is from the horse's mouth. Everything you want to know about the ETF. So we have the core information up here. The performance metrics are down here. Your total returns. I use this with dividends reinvested. If it's been around that long. Now, SCHY has only been around for 2021. It's from Schwab. It's kind of like SCHD, but international, right? So it doesn't have that 5-year total return. But there's compound annual growth rates for the dividend, as well as beta. Remember, beta is a volatility metric. So if you see a beta of 0.75, it means if the stock market goes up $1, then VIGI is going to go up about 75 cents. But if the market falls $1, it's only going to fall 75 cents. I thought this was interesting right here with the performance metrics of since inception with dividends reinvested, the annualized percent, that number one, SCHY, but it's only been around since 2021. But all the rest that have some time frame on them, the two Vanguard funds have been around since 2016, IDV 2007, and DWX 2008, but they all had less than a 10% annual total return with dividends reinvested. But once again, as we pointed out, international stocks have really lagged behind the US market, but that hasn't always been the case, and it doesn't necessarily mean that it is always going to be the case from here on out. Now, I ruled out DWX pretty quickly because it has a high expense ratio of 0.45%, meaning that you're going to pay $45 for every $10,000 invested annually. It's going to come out of the fund. You don't have to pay it out of your account. And I didn't like that the 1.66% total return with dividends reinvested since inception and the 10-year total return of only 41%. And then kind of much the same for IDV. It also has a really high expense ratio of almost 0.50%. And they both have the lowest amount of holdings, 101 and 100. And DWX only has $463 million of assets under management, so it's really, really small. And SCHY actually has a 0.08% expense ratio. It is the lowest one of these on the list. Has a decent yield of 4%, but it only has a low track record of a few years from its inception of April of 2021. And it also has $1 billion of assets under management and 134 holdings. And their methodology is also looking at dividend payers. They had to have paid a dividend for 10 plus years. And the top 100 are ranked by quality and yield. So I thought that was interesting, but I wanted to do a little bit better. And the one that really grabbed my eye was VIGI and VYMI, the Vanguard funds. Now, VYMI has a higher current yield of 4.27% compared to VIGI's 1.87%. And VY, the high yield ETF, has 1,561 holdings compared to VIGI's 354. Now, the 5-year dividend CAGR, VIGI is still underperforming the high yield one by a percentage point and has a higher 5-year total return of 103% to 66% for VIGI. And I could be off base here, and I'd love to hear it from you, but what I like about the methodology is that VIGI looks for companies that are raising their dividend for at least 7+ years and excludes the top 25% highest yielders, where VYMI, they include the top 50% of forecasted highest yielding global stocks, excluding REITs. So it's been interesting because these launched on the exact same date. And it is interesting because they both launched on February 25th, 2016. And so far, the quantity of VYMI's almost 1,600 holdings has outperformed the quality of VIGI's 354 holdings. So personal preference, I guess, and obviously past performance doesn't dictate future results. But Morningstar has a 4-star rating on both of them. The Seeking Alpha analysts and the Seeking Alpha quant both give them a buy, and ETF.com both gives them an A, but VIGI does have the highest PE ratio of 20.6 compared to VYMI's 9. So my thoughts are that if you're retired or in retirement or needing the money right now, I think VYMI might be the better selection, but I'm 47 and I have a lot of years ahead of me until I'm going to be taking this money out of my Roth. So I'm hoping that VIGI will grow that dividend a little bit quicker than VYMI's high yield. And again, I love that it focuses on companies that have 7+ years of dividend growth, a little bit lower expense ratio of 0.10% compared to VYMI's 0.17%. And I think it has better quality companies with stronger long-term dividend growth potential. Now check this out. After I decided on VIGI, I discovered Seeking Alpha compares it with other international dividend growth ETFs specifically, which are DNL, the Wisdom Tree Global X US Quality Dividend Growth Fund, which has a much higher expense ratio at 0.42% versus VIGI's 0.10%. IGRO, the iShares International Dividend Growth ETF, has a better 5-year performance but also slightly higher fees at 0.15%. Ticker EFAD, the ProShares MSCI Dividend Growers ETF, has an excellent dividend growth rate of 4.99% but charges a high 0.50% fee. And IQDG, the Wisdom Tree International Quality Dividend Growth Fund, which has a good growth rate, but again, higher expense ratio at 0.42%. I love VIGI's low cost, the quality holdings, and the potential for stronger dividend growth. And even with all this research, I still hesitated before making my purchase today because I kind of want to stick with what's been working so well for so long, but I decided to start small. I took an exploratory position into VIGI 3 shares at $86.50 to get that flavor in my mouth, get the taste of being an owner, because when you own something and you got money into it, you got skin in the game, you usually pay attention to it a little bit more closely. And I did put that in my Roth IRA, and I plan to add DCA into it until it's somewhere about 2, 3, 4% of my overall investment net worth. Now this could change, and I really hope you share your thoughts and opinions in the comments below about why you do or do not like VIGI and what you think might be better, because again, I have this exploratory position, and if I find something better, the facts have changed in my mind, so I'm going to change what I do. So that should go without saying. This is not financial advice. This is just me sharing what I'm doing with you. Don't forget to go to DapperDividends.com and sign up for my free and fantabulous weekly newsletter, where I share an investing thought, the portfolio activity, dividends received, and some stocks about to go ex-dividend. And as always, if you'd like to save a bunch of money on a Seeking Alpha annual subscription, there is an affiliate link below. But I think it makes sense to diversify beyond the expensive US stocks and into the international dividend growth companies, especially with these valuations. If you found this helpful, hit subscribe, and hey, in this floating little box right there next to my pretty little head, I shared with you how we are generating over $10,000 in annual dividend income. So if you want to see exactly how we're doing that, click that floating little box right there. And if you do that, I'll tell you all about it there.